Hi, this is Mike Larson from Money and Markets TV. We've had one heck of a party on Wall Street in the past few weeks. The Dow Jones Industrial Average shot up almost 1,500 points in just 22 calendar days. Now, the reasons I hear most often are based on a big heaping of hope, as far as I'm concerned. And unfortunately for the bulls, hope is now colliding with reality, and not in a good way. Let's start with the bailout talk from Europe. The latest market hopes there, based on the European Union summit we had this week, are that European banks are going to take 50% haircuts on their Greek debt, and that the 440 billion euro European Financial Stability Fund, or EFSF, will be leveraged up to 1 trillion euros in a couple of different ways. Finally, the idea is that the banks will be backstopped with around 100 billion euros in additional capital. Now, that all sounds good on the surface, but when you look at the action in the European bond market, you see that real money investors just aren't buying the happy talk. Italian 10-year yields have surged up towards 6% again, closing in on the highs they set several weeks back. Spanish and Portuguese yields are also climbing, and the difference between yields on French and German debt just exploded to an all-time high. Now, this is all happening after the European Central Bank already said it would buy PIGS bonds, PIGS country bonds that is, in a futile attempt to prop up their prices. And it's also happening after the outlines of the latest bailout schemes were leaked to the market. Look, the peripheral European countries are virtually broke. The only way they can survive over the long term is if their debt burdens are slashed dramatically. At the same time, countries like Germany and France can't afford to spend hundreds of billions of euros bailing out their neighbors without destroying their own balance sheets. Plus, the circular nature of this bailout fund is downright ludicrous. You literally have countries like Italy and Spain borrowing money and putting those funds into the bailout fund. Then that fund is supposed to turn around and spend its money buying up those countries' bonds. It just doesn't make any sense. Now, here in the US, housing stocks and banks rallied sharply heading into this week amid rumors of a mass refinance program from the Obama administration. Many borrowers are upside down on their mortgages, or in other words, owing more than their homes are worth. And there was hope that essentially all of them would be permitted to refinance into new, cheaper mortgages as part of the plan. But the program rolled out on Monday looks like yet another nothing sandwich in a long line of them. The original Home Affordable Refinance Program, or HARP, was supposed to help as many as 5 million borrowers, but only 900,000 have participated. And the changes we just learned about, while they will ease appraisal requirements and reduce fees associated with refinancing, aren't going to get the job done. Because of the nature of the charges and restrictions on fees that still apply to home loans, this new improved plan will likely only allow a couple 100,000 more borrowers to refinance, and that would be spread out over several years. Folks, that's nowhere near enough to make a dent in the broad economy or the housing market, considering some 11 million homeowners are underwater. Finally, there's a deadline that Wall Street investors haven't been talking about much recently because of all the European shenanigans. That would be the November 23rd deadline for deficit reduction recommendations from the so-called Super Committee. That committee of 12 Republicans and Democrats is supposed to come up with proposals to reduce spending and raise revenue over the next several years. If the committee doesn't come up with a plan, then $1.2 trillion in automatic spending cuts are supposed to kick in beginning in 2013. The problem? Committee members are hopelessly deadlocked, with Republicans unwilling to raise substantial amounts of revenue and Democrats unwilling to cut spending and entitlement programs in any meaningful way. So why is that important? Because Standard & Poor's has already cut its AAA rating on U.S. sovereign debt, citing congressional dysfunction. Fitch and Moody's punted, citing the creation of the Super Committee as a reason for optimism, on the other hand. They said that some kind of deal would likely be reached to bring the deficit down. But now the Super Committee is going to bomb, and that means those agencies won't have any more excuses. They'll have to take action and cut their ratings. And S&P could even cut the U.S.'s rating further. This is the next major crisis that Wall Street fund managers want you to ignore. After all, if they don't manage to prop up the market through year-end, how can they collect their hefty bonuses and stake out a nice Hamptons homestead next summer? My advice is simple. Please don't rely on hope when it comes to investing. Look at the cold, hard facts and the reality on the ground. They suggest we have not seen the worst for stocks, despite the recent rally, and that caution remains your best investment bet. I'm Mike Larson for Money and Markets TV. Thanks for watching.